Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we've got another episode for you. And actually, we're going to be doing another episode in the Fundamental series. Look, you know what? Low key, the Fundamental series is low key my favorite series, even though it's not really getting the love it requires and deserves from you guys. It's genuinely one of my favorite series that I've produced. The reason being is just the information in there is what genuinely made me a better investor, understanding how some of those metrics worked and what to be looking out for. And so if you haven't checked the fundamental series, go and check the fundamental series. We talk about everything you need to know from dividends, dividend cover, payout ratio, dividend yield, and all of the other dividend metrics that are there, history. We talk about assets and debt. We talk about PEG ratio, price to book, PE ratio. We talk about all of those metrics that help you understand the fundamentals of a company, so you guys can just look at a business, value a business really easily, and then work out whether or not it's a good investment. But I'm going to be adding another episode to the fundamental series, and today we're going to be talking about beta volatility, which is a metric that helps you understand how volatile the stock you are choosing is. So if you want to know more, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear and simple way. But first, let's get into beta volatility. So what is beta volatility? Beta is a measure used in fundamental analysis to determine the volatility of an asset or portfolio in relation to the overall market. The overall market has a beta of 1. Very important that you remember that. The market is 1. Market 1. 1 market. Market 1. Simple. Market 1. And individual stocks are ranked according to how much they deviate from the market. So they will deviate either higher or lower than 1, which is the market. What is beta? A stock that swings more than the market over time has a beta greater than 1. If a stock moves less than the market, the stock's beta is less than 1. High beta stocks tend to be riskier, but provide the potential for higher returns. Low beta stocks pose less risk, but typically yield lower returns. As a result, beta is often used as a risk-reward measure, meaning it helps investors determine how much risk they're willing to take to achieve the return taken on that risk. A stock's price variability is important to consider when assessing risk. If you think risk is the possibility of a stock losing its value, beta has appeal as a proxy for risk. Now, in every other fundamental series, I tell you the metric, and I tell you, not only, how to look at the metric and understand the metric, but for those of you guys that want to know how to calculate it yourself, where you don't really have to in most scenarios, but for those of you that want to, I usually typically tell you how to calculate it. For this one, I'm not going to tell you how to calculate it, because you know what? I tried to calculate it and I already understood the metric. I tried to calculate it to make it simple, and it's a madness. It's actually a madness. So it's not even worth. So I'm just going to sum up what I just read to you. The market has a beta of 1. Basically, any stocks that have a higher level of volatility than the market will be ranked higher than 1. And any stock that has a lower level of volatility to the market will be lower than 1, so 0.9 or less, etc. Now, if it's lower than 1, it means it's a less volatile asset, which tends to mean it's a less riskier asset, but also could mean you might get less returns. If it's higher than 1, it means it's a more volatile asset, a more riskier asset, but also it means you could get higher returns. Now, this is the theory of beta volatility. Now, if you have a stock, you can easily go and find out the beta volatility just by Googling it. And I'm sure on Morningstar or Yahoo or NASDAQ or one of them, it will tell you what the beta volatility for that stock is. But if you got Simply Wall Street, it will tell you in this nice little section here called portfolio volatility versus the market. This, in effect, is beta volatility. So as you can see here, the market average is a beta of 1. Anything that's higher is technically a little bit more volatile. Snap 1.09, CYBG or CITV 1.16, First Solar 1.3. Anything that's below is technically less volatile. LGen 0.88, Taylor Wimpey 0.84, Vodafone 0.61, and Trig sitting all the way down here 0.18. And you can kind of tell by these icons, this is a bed, so this just basically it's a sleeping dormant stock, and this is lightning, so it's more volatile. That's the way they've tried to showcase what that effectively means. But I think it's a good secondary metric for you guys to look at. I kind of referred to it a little bit yesterday, but I didn't really give it some time to actually explain what it meant. So I just wanted to do a very, very quick video today just explaining what beta volatility means and how you can really apply it to your portfolio decisions. And I think it's really, really useful, because if you look at my portfolio, it's saying that my portfolio on average is 0.73 in terms of a beta volatility. So what that is in effect telling me is that, Curtis, you have played it quite safe with your portfolio. It's not as risky as you may have thought you are. I thought I was a bit of a, risque guy, a risque person. Turns out I'm not. The data proves that I'm not actually as risky as I thought I was. So I might need to throw some high risk stocks in there. No, that's not really how you use it. But generally speaking, it's telling me that my portfolio is quite safe. And if I want the opportunity to get higher returns, then maybe the way I perceive this metric anyway is that I should be looking at potentially adding some more growth stocks to the portfolio with a bit more volatility. Now, when I look at the ones that are above the market, CYBG's been terrible. So that is one that's very volatile and it's been bad. So that shows you that it can have a high potential, but it's not been that great for me so far. There has been times when it's been in the green, don't get me wrong, but at the moment it's not doing so great, and generally it's not been that great. Snap, however, has been great. We all know that Snap has been great this year. It was my stock to watch way before it started to rocket up around a $10 price point, something along those lines. I wanted to get it. No, actually, yeah, it's about the $10 or $9 price point at the time I wanted to get it. Obviously, now it's sitting at about 17, 18, etc. It went higher, it's kind of pulled back a little bit, but Snap has been a very decent stock this year. First Solar, as you guys know, has been one of my best stocks. At the moment, it's not doing amazing, but generally, at the time I bought, it was probably up around 40%, but I only had bought like one share, which was very, very disappointing. Go and check my portfolio updates to have a look for yourself. So this shows me that two out of three stocks that are higher than the market average have performed pretty decent for me. And so there is a potential that if I just, if I take that as the benchmark, then if I add another, say 4, then I might expect, that 3 might do well, 1 might not, or 2 might do well and 1 and 2 may not, etc. But it's just another metric to kind of consider. Me personally, I'm actually happy that my portfolio isn't that risky for the moment. But I think going into 2020, when I start reviewing my strategy, and depending on if this recession lands and what happens in that space, I might obviously try and buy some higher growth stocks. In the recession video, I did mention that one strategy people try to do is that when they feel like a recovery is sort of coming out of the recession, people sort of invest a lot into high growth stocks and make not a fortune, but they make a lot of money. So that might be a strategy. But at the moment, I think it's worthwhile you guys checking your beta volatility and trying to work out how volatile is your portfolio. Mine is not that volatile, which is good. It seems like it's in quite a safe place. But obviously it does mean that I might not be getting the amount of returns that I should be getting and maximizing the potential of getting a greater return. So, that is something for me to think of and think about. And I generally probably would like to move it upwards a little bit, because if you consider that this is a level of 1, and when you read the article, which I'll leave in the description, it talks about 1 being like the S&P 500, which is considered the market and the benchmark, then you know what, I could just put all my money into the S&P 500 if that's the case. So in that scenario, I should be trying to look at some growth stocks which will help me, beat the market, so to speak. But yeah, hopefully you found this video useful. Just a quick video, and quick by my standards, because I like to talk. So yeah, beta volatility, go and check it out in your portfolios and see where your stock's at. And work out, is your portfolio volatile, is it not volatile? and what are you going to do to change it either way. If it's too volatile, you might want to bring some safe ETFs into the mix, and bring the risk of your portfolio down a little bit. So that also might be something you want to do. Get in the comments, please like, please comment, please subscribe, and I will catch you next time with another investment video. Take care, guys. Peace.